Dear students, welcome to this revision session. This is the series of revision session. This is the third one in the series. We are about to conclude the ACCA mock exam for December 2025 sitting. And this is the interpretation question. It's a 20 marker, and the ACCA people have given the specific tips for the interpretation question. The secret, the top tip to get good marks in this interpretation question is to write specific answers. Usually, students would just calculate the ratios and give general reasons, okay? So if you are going to write or give a general feedback or a general response, you're not going to score many marks, okay? A very important, exam technique here is that it's very like students usually try to just learn the formulas and apply them. So that will only fetch you 4 marks, okay? That is kind of nothing. And you are giving up or you're not focusing on the juicy 16 marker, because here you are expected to discuss the financial performance and financial position. So the performance is more focused on the statement of profit and loss, and position related to the statement of financial position, which has assets and liabilities. Okay, so we can always have general points that the sales might have gone down, the cost of sales might have increased, or the expenses might have increased, or the incomes might have increased, things like that. So these are general points, okay? These are all right, but you have to find specific information given in the question. You see, the examiner designs the interpretation question in a way that those points are there as hints. Those hints are there and those must be used in your answer. So while going through the data available, we're going to look at each and every point and we're going to relate it to the results, and we're going to make our analysis more realistic. By realistic, I mean it is going to be related to the situation of this company, that is Corico. Okay. So I hope you understand. The more specific your answer is, there is a greater chance that you will score well in this question. But if you keep on the general comments, then you will not be able to score a lot of marks. You might be just able to score like maybe 25 to 50%. That's about it. The 16 marker is not going to give you like anything like more than 5 to 6, or like maybe 8 marks with the general answers. Okay, but if you look at the details, you will be able to write an answer that is going to fetch you a lot of marks. Okay, so this is the top tip for the interpretation question. People usually think that this is a very easy question, but it is a very tricky one, and you have to relate to it. So first of all, you discuss the results of the ratios that we're going to discuss, that we're going to calculate in the 4 marker, and then we have to like simply discuss whether the numbers have improved or the numbers have become worse, but then we have to relate to the reasons. Okay, so it is key to the success in scoring marks in this one. Okay, so I believe this one is fine. We have enough of the discussion. We can now move on to looking the specific information. Okay, let's see. So we have let me just go through the question and understand. So we see that the lower marks are number crunching, the major marks are the theoretical interpretation points. So let's clear the drawings first, and let's look at the circumstances of this business. So what are the circumstances, what they have been going through, and so on. So here we go. We are provided with plenty of information for this company, and let's see. We have okay. Corico is a clothes manufacturing company with a majority of its revenue generated through sales to fashion retailers. Okay, so these points are also important, that these are selling through fashion retailers. It is not a necessity. They are a manufacturing business, so when we're going to talk about their cost of sales, it is going to be the cost of material, the cost of labor, things like that. Okay, and their majority revenue is through the sales through the fashion retailers. Okay, so this just are the general points related to the manufacturing business. Okay, there are going to be plenty of points which are going to be specific to this manufacturing business. It's summarized financial statements and ratios for the year ended 31st of December 20x6 and 20x5 comparative for statement of profit and loss and the other comprehensive income are as follows. Okay, so we are provided with the statement and the ratios as well. So the ratios will be below. Let's look at the overall situation before we look into any ratios. We have the revenue for 2005 and the revenue for 2006. You see, the revenue for this year has gone down. The revenue is 59. Okay, so we will investigate what is the reason why the revenue has dropped. There is a drop in cost of sales as well. The cost of sales was 53. It has now come down to 51. So all of these points are important. You see, the drop in the cost of sales is very small as compared to the drop in the revenue. Okay, so we're going to calculate the total drop, and then we're going to calculate the percentages. Okay, so the sales have dropped by a greater proportion as compared to cost of sales, and that is the result is the uh, another drop in the gross profit. The gross profit here is 8 million, whereas in the last year it was 19 million. The operating expenses have slightly increased. They have gone to 8.7, and previously they were 8.4, and this has resulted in an operating loss. Okay, last year we had the operating profit, but now we had an operating loss. So on surface this seems to be a very poor performance. Okay, uh, just looking at the information, there has been a loss on remeasurement of financial asset at fair value through profit and loss. So that has also contributed, which is not really an operating issue, and did not it is not related to the performance of the business, but this has impacted the profit. Okay, already we were running a negative operating profit, and there is some more loss on the remeasurement of fair value through profit and loss financial asset. So then we have this profit before financing and income tax. These are the terms for the new standard IFRS 18. And then we have this interest expense on borrowing. So the interest expense has also increased. Maybe there is some increase in the borrowings as well. Let's see. And then there is this profit before income taxes. This clearly there is a loss, so there is going to be a relief. Previously there was a profit, so we had a tax, so here is going to be a relief. And then we have this profit. The overall profit is for the previous year it is 7.1 million, and now it has become a negative 3.1. Okay, then if we scroll down, we have this revaluation reserve. There is a further loss in the revaluation. Okay, so overall, this company seems to be losing way. Okay, the costs are rising, the sales are going down. There is loss on the remeasurement of the asset. There is revaluation. So there seems to be multiple issues. Okay, so let's see. So from the like the basic information, it seems that the company is not doing great. Okay, overall, there's a total comprehensive loss or negative income that we have. And if we scroll down, let's look at the statement of financial position. So we have the overall idea. Moving on to the statement of financial position, and then we can see the information. We have this we have the property, plant, and equipment. We have the financial asset through the fair value through profit and loss. You see, this was referred to have gone down in the same year because we see a charge related to it. And we have inventory, we have trade receivables, we have income tax asset, we have bank, and we have this equity. We have 26 million shares, share premium. There is no revaluation reserve. There is a retained earnings of 7.2 million. The non-current borrowings, the non-current liabilities have the bank borrowings, the deferred tax, the current tax, the trade payables, and we have the total equity and liabilities. Okay, so these figures, we cannot say anything about them because these figures are only for the current year. These figures are not for the previous year, like the statement of profit and loss. Okay, so we cannot really compare it right now. So let's see what is the information that is available to us so that we could get a better idea. Here we go. So let's see what is the situation so that like we have seen things, the things seems to be going in the downward direction. Let's see what other information is there that can help us understand this downturn trend in the performance and the position of the business. The following information has been provided by company directors who have publicly announced that Coric performance has been affected by overall economic recession. Okay, so the directors know and they have announced this fact publicly that the performance is not great, and this is they related to the overall economic recession that this country might be going, and this is having a negative effect on the company. However, the company has shown resilience despite the costs mentioned below. Okay, so this is going to be the breakup of the cost so that we could understand why the results are poor. Okay, so let's see the statement. This statement is does not seem to be making a lot of sense that the company is resilience or has shown resilience. Okay, because the performance looks poor, but let's see why they're saying that. Corey factory building has suffered impairment or revaluation losses of 11.5 million in the year ended 31st of December 2026. Okay. Now this makes sense that there is a huge impairment loss, and this has made the profit go down. The excess of these losses over previous revaluation surpluses have resulted in a charge to cost of sales of 2.5 million. Okay, so we saw that the cost of sales figure has come down, but it hasn't come down with the same proportion as the revenue has come down. The sales have reduced with a greater proportion, but the cost has not. And I believe this is the reason. You see, they have charged the impairment related to the previous revaluation surplus in the cost of sales. Okay, and there were no additions to or disposals of the property, plant, and equipment during this year. So clearly, we can understand that the cost have remained pretty much the same due to the charging of the impairment to the cost of sales. Okay. Now, furthermore, as a part of cutting cost cutting strategy, the company made some senior and skilled employees redundant during 2026, incurring redundancy cost of 1.8 million. These are included in operating expenses. Okay, so that really now makes sense that these are one-off costs which are only in this year because we have had this cost cutting strategy and we have made some employees redundant and we have to pay some redundancy cost, and those are included in the operating expenses. So these costs are not going to be in the next year. So these costs are only for this period. So we can say that things might get better in future. Okay. Corico also has also reduced its expenditure on marketing and advertising, which is also including in operating expenses. Okay, so they say that the marketing cost has reduced. Okay, so this shows why the revenue has dropped. Okay, because you see you have to spend on marketing and advertising for the revenue to increase. We see that there is a sharp decline in the sales revenue. Okay, this could be the reason that they have reduced the marketing cost. So this all this information is helping us making sense of the seemingly poor performance that we saw up through the comparison. Okay, so there are certain costs which are not really operating costs, like the impairment loss, like the redundancy cost. Okay, and like the cut in the marketing expenditure, so that has reduced the sales. Okay, so we can now see the bank balance of Corig has improved by 2.2 million, and the bank borrowings have decreased by 1.5 million as compared to the balances at the previous reporting date of 31st of December 2025. And Coric's bank borrowings are on a variable interest rate. Okay, so this is the situation has improved, that the bank balance has improved by 2.2 million. So that's a positive thing, that shows that there is money. And this seems to be uh, you know uh, something which is not clear, because the borrowings have gone down, the bank borrowings have decreased, and the bank balance have increased. So there must be something else that is generating money, that is generating cash. We have improved the bank balance, and we have also reduced the borrowing. So where is the money coming from? Let's see. The company has made fully subscribed right issues. So this is where the money is flowing in to make the bank balance positive and to reduce the bank borrowings. Okay. So you see, now the information is making things clear for us. Okay, so the company made a fully subscribed rights issue during this year to help improve cash flows. The directors reduced the dividend per share by 45% as compared to previous year. So whatever dividend they were giving, they have given a dividend, but that dividend is 45% less. Following is the extract of Co's equity at 31st of December 2025. Okay, so we found some reasons why the profit has gone down. We found some reason why the cash flow has improved because of the share issue. And this line is important, that the company made fully subscribed right issues. This shows that the shareholders have faith in the company, that the rights issue were fully subscribed. And this also shows that in such a situation, when the profits are going down, they might have opted for no dividend, but here they gave dividend. However, it was less than previous year, but that must have contributed to the confidence of the shareholders. Okay, because you see, the right issues were fully subscribed. If the shareholders had no confidence, the right issues would not have been fully subscribed. Okay, so the dividend payout strategy seems to be working here. So I believe this is we've gone through all the information, and we have found a lot of links, and we're definitely going to use them while we're going to interpret, and we are going to attempt a 16 marker that is related to the discussion of the performance and the position. Okay, so let's move on. I believe you are with me, and you're making sense of things. If you find yourself lost in any point, you can just stop me and I will discuss it for you. Okay. So I hope you're doing strong. So now we're looking at the equity situation. Uh, this is the equity situation following the extract of Codeco's equity at 31st of December 2025. Okay, so we have the equity here. They have given us the equity for the current period, and they've also given us the equity for the previous year. Okay, so it will be really useful if we could put the information in front, so that we could compare things and we could understand the changes. Okay, this is the equity for the previous period for 2025, and we have certain ratios as well, so we're going to be calculating the ratios. Okay, I've got some feedback. Let me just check. Okay, so it seems your people are fine, you're following me. So here we go. We have this equity for the current period, and we have the equity for the previous year. Let's see, now let's compare. There has been, you see, the equity share capital has gone up it was 24, but now it has gone up to 26. There was no share premium here. There is a share premium. It means that we have issued the right shares at a premium. There was a revaluation reserve of 9 that is gone because of the impairment. And we had the retained earnings. We had this retained earnings of 12 million. The retained earnings have gone down to 7.2 million. This is due to the dividends, and this is due to the loss that has been made. Okay, and the major reason for this loss during the year was the impairment cost, was the cost of redundancy, and was the fall in sales revenue. So these were some major costs that we covered this period. Okay, so let's go through the other pieces of information before we actually start calculating these ratios. Okay, so I believe you must have found a lot of relevant information that you can use in your answers. Okay, here we have this. So we've gone through this information. I just wanted to discuss this portion, and now we can see what other information we have. And that's about it. That is the information that we had. Now we are ready to calculate the ratios, because we have to uh, earn the first 4 easy marks, the thing that I call number crunching. And that is easy. You just need to know the formulas and you can just quickly calculate. So those ratios are already provided to us for the year 20x5. So now we have to find out the ratios for 20x6. So we'll just write down the ratios in front. First of all is your gross profit margin. And let me just bring down the relevant information, okay, so that we do not have to scroll down all the time, and we find things easy. Okay, so some of the information will be in the profit and loss figure, and some of the information will be understood by looking at the statement of financial position. So right now what we're looking at is the ratios related to the profit and loss. So let's bring the data in front and we can calculate the figures and understand. Okay, so here we have this first piece of information. So that is first one. We will be doing the workings here. I'm only going to write the final answer here. So first one is your GP margin. That is going to be your GP divided by sales multiplied by 100. The gross profit for the period is 8, and we do this 8 million. We divide this by the sales revenue, which is 59 million, and we can easily calculate into 100. You people can do the calculations for me so that we could write down the formula here. So that is 8 divided by 59 multiplied by 100. So that is 14%. Let me just unround these figures so that we could have the precise answers, because I've got these rounded.
13.56.
That is 13.6.
13.56.
13.56. Okay, so that's fine. We could just keep it. So that is 13.56. If we just we could just keep it to one decimal place, because the ratios that are already calculated for us are also for one decimal place. Okay, so let's keep it to 13.6, and let me just reduce the font size as well, so that when we calculate them, they can be seen in front. Okay, so that's the first one. Looking at the second one, which is your the operating profit. So in the case of operating profit, we have the loss. It's going to be a negative thing, because the operating profit margin is going to be the operating profit divided by sales multiplied by 100, and we can calculate it by the loss that we have, 0.7 million, and we divide this by the sales that we have, 59 million. 59 million multiplied by 100. So that is going to help us calculate this value. So that is 0.7 divide by 59, multiply by 100. So that is, okay, let's just put the sign here. So that's 1.2. Okay, so here we had the operating profit margin of 14.7, but here we have a negative 1.2%. Okay, so and now we move on to the return on equity. So what is the profit that is available to equity? I hope students, you people are finding these figures easy. This is 13.6%. We can just write it here as 13.6%. This is just simplify this thing so that, yeah, that is going to make more sense now. That is 14, 13.6 rather, 13.6%. This one is negative 1.2%. And then we have this return on equity. So the formula for return on equity is we have the equity provided to us. So that is return on equity. The return is negative. We see that the profit that is available to the equity is 3.1. So we have the negative 3.1 divided by, we have to find the equity figure here. So for that, we need to scroll down. This is the equity for 31st of December 20x5. The equity for this period is, we look this up here. So here we have the equity as 35.2. The equity is the total equity, including the equity shares, share premium, revaluation reserve, and retained earnings. So that is 35.2. So we're going to write it here as 35.2 million. And so this is how we calculate this figure. We could find it. There is also percentage. So let's multiply it by 100 to get the exact answer. Yes, you can check by figures. 3.1 divided by 35.2 multiplied by 100. So that is a negative of 8.81%. Last year we had a positive return on equity of 15.7. Okay, so now we have the net asset turnover. So we have to have this. Let's see the net asset turnover. We have the sales, which are 59, and we divide them with the total non-current assets, the PPE. Let's see what is the figure for that. The non-current assets for the year 31st of December 2086 are 35.2 million. So we need to scroll up a bit, or we could just bring down these figures here. That is 35.2. So we could say that the net asset turnover is 35.2. So that is going to be in times. Let's see the net asset turnover. 59 divided by 35.2. So that is 1.68. So this seems to be a surprise because this is, we can say 1.7 rather, if we just keep it to one decimal place times. So this has improved surprisingly, like all the figures have gone down. The net asset turnover in the year 20x5 was 1.5, whereas this year it has gone up to 1.7 times. Okay, and now we look at the gearing. Let's look at the gearing. The debt that we have here is the information. So the long-term borrowings are 8 million and the equity is 35.2. So we say that we have this gearing. Gearing is equal to this debt, which is 8 million divided by your equity, which is 35.2, and we multiply that to 100. So we are going to have this answer here. So that is 8 divided by 35.2 multiplied by 100. That is going to be 22.73. Now this is 22.7%. So this is not much of a difference because in the last year it was 21.5, whereas this year it is 22.7. Okay, we've got some questions. Yes, please, what is the question?
For the net asset turnover, is
Yes.
that we're doing 59 divided by 52.4?
35.2. The sales revenue is 59, and
Yeah.
the net assets is 35.2. If we just scroll up, the property, plant, and equipment is 35.2. We take the sales as a comparison of whatever we have invested in the non-current assets, which is property, plant, and equipment. I have not included the financial asset because that is not part of generating the revenue.
Okay, I hear you. Thank you, sir.
You're welcome. So we are done with most of the ratios. We see that the gearing hasn't moved much. It's just a nominal increase. And then we now look at the trade payables days and the receivables collection period. Okay, so let's do the formulas here. I'm just doing it in a way so that you could see the information and the formulas in front. So let's see the trade payables. Okay, so the trade payable period is going to be your payables divided by your purchases or cost of sales, whatever is available. So we have the payables. Let's see the payables figure and then divided by cost of sales. We have the cost of sales. The cost of sales is 51 here. Okay. No, that's not the case. This is just a coincidence in this question that the net assets and the equity are equal. Okay. So don't get confused by it. You see the total non-current assets are different figure. So you cannot just substitute the equity for net assets. Okay, you see the students who were looking at this figure, they are getting confused by the equity. You see, in this specific question, we have the property, plant, and equipment of 35.2, and the equity is also 35.2. So this is just a coincidence, fine? So don't get confused by that. The examiners usually give such information so that the students get confused, like the consolidation question had a had a negative goodwill at the bargain purchase. So when you're in the exam, you must be thinking that I must have done something wrong. Okay, so let's move on. If we look at this portion here, we have the payables here. The payables are 6.8, and we compare it with the cost of sales. So that is 6.8 divided by, we have the cost of sales is 51, and we multiply that to 365 to get the days. Let's see, the payable days are going to be 6.8 divided by 51 multiplied by 365. The answer is 48.7 days. Okay, so previously the payable days were 23, and now the payable days have gone up. This shows that we are taking more time to, or we can just say 49 days. Okay, so we are taking more time to pay the payables. This would have contributed to the improved cash flow position. We have seen that the cash flow position is better now. We have a positive balance in the bank. So, but this could harm the relationship with the payables. Okay, they might not give us the discounts, and they might also not give us the supplies because we're taking too long to pay. Okay, because we are becoming vulnerable for them. They might think that we might run away and do not pay the money. Okay, so that's a serious tricky thing. So we have to keep this thing in check. Okay, this is getting out of hand because from 23 days in the previous year and going to 49 days, it's a huge jump, and this could make the suppliers uncertain, and they might panic and they might stop selling us the raw materials. that could be a serious problem. Fine. So let's see. The next thing that we have is the receivables collection period. So we have this for the receivables, we need to have the receivables. Let's see what is the receivables figure here. The receivables are 4.4. We're going to divide them with sales. The receivables collection period is going to be 4.4 divided by the sales is 59. We multiply it with 365 and we get the answer. So let's see. That is 4.4 divided by 59 multiplied by 365. Let's see what is the answer. Oops. Okay, so this is, I think we need to do it step by step. 4.4 divided by 59. That is 0.7 into 365. That is actually 25.5, or we can say 26 days. Okay, I think we can just recheck this working as well. This is the trade payable 6.8 divided by 51. That is, let me just check that it might not be 2. So that is 0.13. 0.13 into 365. That is 47. Yeah, that is fine. This calculation is all right. That is 49 days. However, this one was not, this is 26 days, the receivables days, okay? So we now look at the last one, which is the inventory holding period. The inventory that we have is, let's see, the inventory is also 4.4. The receivables and inventory are the same figure. So for the inventory period, we divide the inventory by the cost of sales. Yes, what is the question?
So for the receivables, it's receivables divided by sales, right?
Yeah,
Times 365.
multiply by 365. That is for days.
I'm finding 27.2.
You're getting 27.2.
Yeah, unless I've got it wrong. Because
Okay.
I did 4.4.
Can you double check in the meantime? I'm dealing with the inventory, and then we can check it. Okay.
Yeah.
The inventory holding period is equal to 4.4. Divide by the cost of sales, which is 51, multiply by 365. Let's calculate the value here for the inventory. That is 4.4 divided by 51. That is gives us 0.09. So 0.09 into 365. That is 33 days. Okay. So yes, have you checked it?
Yes, I got 27.22.
Okay, so I think that should be 27. Let's check it again. This is your receivable days, 4.4 divided by 59. It gives us 0.07. So 0.07 into 365. I'm still getting 25. Anyway, let's check it. We're going to look at the answer as well. Excel is not allowing me to do the complete calculation. It gave me a weird answer of 220 days. Okay, so we can check it. What is going wrong? Can anyone check it this for us? Is it really 26 or 27 days? Anyway, so we have got it. So now let's compare the days here. The inventory holding period was only 18 days. Okay, so we used to hold inventory for less time, and now we are holding a lot of inventory. And because we can say the sales have gone down, the receivables are also taking more time. They were taking 19 days to settle, but now they are taking 26 days. This might be due to the recession going on. Every business is struggling, and the payables we have, delayed their days by a huge fraction. Okay, that is now 49 days. So this is these are the ratios which were required to be calculated, and this gave us only 4 marks. Okay, so now comes the real tricky thing, which is in terms of the performance and the position. Okay, so we have discussed all the aspects, and let's see, because we have identified the issues which are related to the case. Fine. like their specific situation, their redundancy cost. So overall, when we looked at this profit and loss figure, it seemed very bad. Okay, the sales is going down, the cost of sales is not going down with the same proportion. So things were looking really bad. But when we looked at the other information, that there was, the impairment loss being charged, the redundancy cost is also there. There is also loss on the remeasurement of the financial assets. So all of these things have really contributed to this poor performance. And these cost, the redundancy cost, and this impairment, and this loss on the financial asset, these are all one-off costs. Okay, so these are not going to happen every year. So this seems that the comment of the directors, they say, however, the company has shown resilience despite the costs mentioned below. Okay, so their comment is now making sense. Okay, the company directors have said that the performance has been bad due to overall economic performance, but they also say that it is doing well. It has shown resilience, like it is showing good things despite the poor situation, poor circumstances, and the kind of business they are. They are selling fashion products. So clearly, if the economic downturn is there, if the recession is going on, people are likely to spend less on the fashion products. Okay, so this is making sense. So we have gone through everything. I would like to go through all the information with you people in the solution, so that we could better understand how the examiner thinks, how the examiner would interpret the things, and how we have seen. So let's see. Yes, you are right. It is 27 days. That's correct. So yeah, there will be some calculations in Excel. Otherwise, the other calculations are all fine. Okay, so let's see how the examiner has gone through with the information, how they expect you to write the answers in the question. Let's see. We have discussed our own thing. Let's see what they think. So initially, they're just going through the simple things, like the fall in the overall sales. You see, Craco's statement of profit and loss reflects the economic recession. Revenues have gone down. So this revenue gone down is the fall in sales. Okay, the sales in the previous period were 72, and now they are 59. Okay, so if we just quickly check these figures, we can understand. So the sales now are 59. So previously they were 72. So if we take the difference of 72 and 59, it is 13. And if we divide 13 by 72 and multiply by 100, we get this 18% fall in sales revenue. Okay, we've already seen that the sales revenue have gone down. So this is the calculation in terms of percentages. The gross profit has also gone down by 58%, and the operating profit by 106%. They're saying 106 because the operating profit is not really a profit, it's a loss now. Okay, so if we just go through and understand these figures, this is talking about your the sales, and this is talking about your cost of sales, and this is talking about your gross profit and operating profit. The gross profit has gone down from 19 million to 8 million. We have calculated the figure, and this operating profit, it was 10.6, but now it is a negative. It's a loss of 0.7, and we have seen that this is due to the impairment, the redundancy. Okay, so they say that it was 10.6, and now it is below zero. It is a loss. Okay, so if I go back, now things will make more sense why they say it's 106%. It was 10.6 million, but now it is negative. So that's why they say operating profit has converted into a loss. Okay, and a positive after tax of 7.1 million has reversed to a loss of 3.5 million. So this is referring to this statement, like we have this overall profit of 7.1 million in the previous year, and now it has become a loss of 3.1 million. Okay, so this shows a very seriously poor performance. Okay, This in turn has led to a 15.4% return on equity. Okay, the return on equity was 15.4%, but now we have a negative return on equity that we calculated as 8.8%. Okay, if you move on, now they are going to discuss the reasons that we also discussed, that the decrease in the cost of sales is less in proportion. Why the cost of sales has not decreased as much as the revenue? This is because of the impairment expenses. Okay, the impairment expenses related to the factory have been charged to cost of sales. Also, there may be fixed production overheads and high cost of raw materials contributing to it. So as I said, that you see this is a manufacturing business, so we must discuss the raw materials. Okay, and we also saw that they are reducing their marketing expense, and they say that the decrease in the marketing expenses can be the reason for a decline in revenue in the current year and may also decrease future potential revenue because of decreased visibility. Clearly, when you spend money on marketing and advertising, you're more visible and you're likely to have more sales revenue. So this is also contributing in higher, your inventory holding period. You're not able to sell all of them. Your receivables are also taking time to pay. Okay, now they're saying that this deeper, closer analysis have shown that the performance of the company may be better than initially indicated. The downturn has resulted in several additional costs in 2026. That is the employee redundancy, factory building impairment losses, and the financial investment loss. Okay, because there was this financial asset through fair value through profit and loss, that there was a loss on that. So these are the three major costs which has hit them this year, and that has contributed to a loss or an operating loss and a final net loss. These are likely to be the non-recurring costs, so these are not going to happen every year. So if we just take them out and then we can compare the performance of the business, and if we do so, the company has done well. Okay, and so the statement of the director makes sense. If a non-recurring costs are removed, okay, like if we make a comparison and if we take away the impairment cost and the other cost, then we could say that we have converted this into a profit. Okay, a gross margin of 27.8, because they say if we take away the cost that is in the the impairment cost, the redundancy cost of 1.8 million, if we take that away, so we could calculate a gross profit margin, and that would be the one that was 27.8 in 20x5 would result in a 17.8 million gross profit if the impairment loss of 2.5 million was removed from the cost of sales. Okay, so there would be a better gross profit. Okay, based on the 10.5 million revised gross profit. So they say that this calculation is if we revise the gross profit. So this clearly shows that the performance is not as bad as it seemed from the first impression. Okay, so here we have this the operating profit would also be lifted by getting rid of the redundancy cost, considering it's a one-off cost of 1.8 million, and the impairment cost would be 3.6 million, leading to a positive operating profit margin of 6.1%. Okay, so what was the negative operating profit has turned out into be a profit, the positive, and they have calculated the figure. You could calculate the figure or you could just mention it. And the decrease in the marketing has decreased in the operating expenses. So this is one factor, that marketing cost has reduced the operating expenses. However, the more dire impact is the loss of revenue. Okay, it's not a good thing to reduce marketing expense, because the other effect is more devastating. The revenue has gone down. Okay, and this has also contributed in the negative operating profit. So if we move on, given the decline in the economic conditions in 2086, these are probably reasonably good results and may justify the director's assertion that company is resilient, but data on industry performance would be required to confirm this. Okay, so this is, now we're talking about the limitations of the ratio analysis. that here, if we were provided with the information related to the competitors' information, we would have better analyzed the situation. Right now, we could just say, just considering the poor economic condition, things seem good. Okay, the cost cutting measures provide short term benefits. Okay, because you see, we have got rid of our employees might be hired by the competitors. We might not find such skilled workers, and that is going to be a long term loss. Right now it might seem good, but later on, yeah, even right now, we had to face the redundancy cost, and in the future we will have unskilled workers, and those skilled workers might be hired by competitors, and the competitors might make good use of them. So that is really not a good move. That's a really good point. Okay, so that is the point that is going to lift your answer here. Okay, how you use the redundancy and laying off the workers point. So this was about the performance. If we look at the overall position of the business, let's see. the In the statement of financial position, we see that the assets have lost value due to impairment. We have discussed about that. There is a 2.1 million loss on the fair value through profit and loss. So overall, the position also looks weak because of those the impairment losses and the loss on the investment. Again, that could be related to the economic downturn. However, this has reduced the decline in the return on equity. This is showing the other thing, that the return on equity is declined and contributed to perhaps unexpected improvement in asset turnover. Okay, since you see the value of the assets has gone down, so that has resulted, you see, we saw that the asset turnover was better. Okay, and that is the reason, because the value of the assets has gone down, the denominator in the formula has gone down, and that has resulted into a better asset turnover. Fine. So you see, we are understanding all the aspects that we have discussed. This was one surprising ratio that was better. Okay, now we got the reason why it is better, because of the impairment losses. Further, we discussed the bank balance getting better. That is through the right issue, the money raised through right issue, and we also discussed that the shareholders have shown confidence in the performance of the company because they have subscribed everything, and we have used this money sensibly by settling the bank borrowings and by improving the bank balance. Okay, so this must have given more assurance to the lenders and to the shareholders. Okay, moving on to the next thing, we have this retained earnings, we have this dividend. They say that the dividend is 45% less, which means that we are still paying 55% dividend, which might not be looking good considering the situation, but at the same time, this must have supported the full subscription of the right issues and the improvement of the cash flow. Okay, if we would not give the dividend, the shareholders would not have the same confidence in the company. Okay, so both sides, we discussed that it might be bad because of the situation, and it might be great to win the confidence of the shareholders. Okay, so now we come to the working capital ratios, where we have the inventory days going up, the receivables period going up. Okay, so this is probably due to the revenue going down, and this has caused the problem. Okay, that the inventory holding period is going up and the receivables are taking more time. The higher inventory period suggests possible overstocking or slow moving inventory with a risk of obsolescence, especially in clothing manufacturing. Now, this is the point that is related to the fashion industry, that people are not really do not have the space to go for the fashion clothing and follow the trends. So that could be the reason why the stock is not selling. Okay, so this could raise liquidity problems when the receivables take more time, and this might show poor credit control or something like that, or we might have extended more credit because the sales are not taking place on the retailers. This could be the thing. okay, especially when the gross profit margin and the operating profit margin are also decreasing. Okay, so we have to make these things, and now comes the payables period. Again, we discussed that this is not great because this would deteriorate the relationship with the suppliers. They might not give us the supplies anymore, and we might not get the discount on prompt payments. Okay. Okay, so here we have this gearing. There is this, we saw that there was a very small, a nominal increase in the gearing ratio because that is due to the fact that we have this right issues. The equity has gone up, okay? Despite the right issue, the equity in terms of shares has gone up, but the overall equity has gone down because of the operating losses, and the operating losses are due to those impairment, redundancies. Fine. So overall, if we look at the conclusion, we could say that things are not as bad as they seemed, and they are doing well. The Coric results have been adversely affected by the economic recession. Its underlying performance is better than first impression. The company needs to improve the revenue and the working capital management. The impairment of factory may reverse in future when the economic conditions improve. Okay, so this is also important. What has gone down might come back. It would be useful exercise to compare Craig's performance during this difficult time to that of its competitors or industry averages for a more comprehensive analysis. Okay, so students, we have looked at all the aspects. We have calculated the ratios as well to understand, and the most critical thing that you must note in such an answer is that you need to relate the specific circumstances with the results. Okay, we have to give the rationale. The rationale has to be from the case study, like whatever is the information given in the question. If you relate to it, if you are successful in relating to it properly, you could do very well. Okay, otherwise it's very difficult to gain marks if you are writing general answers. So you have to find the information in the question to relate to the figures. Okay, so if you can do that, then there is a good chance that you can score 100% in this interpretation question. Okay, so I believe this was a good experience. Usually students tell me that they are not strong in the interpretation question, but I believe this question must have given you a lot of confidence. Yes, people, what are your thoughts?
Okay, for me, I think just as your stated, is understanding the business and making it specific. But I'm just looking at this explanation, having to give more because there is no like a standard of this is how the response is going to be, but it still
Exactly.
boils down to
We have to be specific, and every question is likely to be different depending on the circumstances given in the question. Okay.
okay.
So students, we have this plan of attacking the EPS. As I told you people, that EPS has those 5 issues, and in the next part of this revision session, I plan to cover those 5 areas. Those are actually 5 questions. So once we do those 5 questions, we will be able to completely comprehend the EPS. Okay, so should we take a break or should we attack the EPS right now? A small 10 minutes break, I guess, and then we have these questions ready.
Yes, 10 minutes break, please.
So fine, a 10 minutes break. Okay, I have uh, 9:04 here. Yes, so let's have a 10 minutes or 15 minutes. Tell me. Dear students, the next agenda for this revision session is EPS. Okay, EPS is one major standard that has created a lot of problem. We have covered few questions related to EPS that were tested in section A and section B. But now here, this session is dedicated towards understanding the EPS completely. So when it comes to EPS, the IAS 33 distinguishes EPS into two. One is the basic EPS and the other one is the diluted EPS. Okay. So the two issues in basic EPS are the bonus issues and the right issues. Okay. If you remember in the second revision session, we did a question for the rights issue. So here, the first question that awaits us is related to the rights issue. So basic EPS will have a right issue and bonus issue. Fine. And the other two issues are related to the diluted EPS. In one of them, you will have the convertibles, and the other one is going to be the share option. So in diluted EPS, we will have the share options and the convertible loan stock or the convertible instruments. Fine. So first of all, we are going to attack basic EPS. In this first question, we will be dealing with the right issue. In the second question, we are going to be dealing with bonus issue. And then there's another situation where we have to calculate the EPS for the previous year. That is the fifth issue. And we're also going to do that. And then we're going to have this diluted EPS. And in this case of diluted EPS, we have the convertible bond question. And in the last one, we have the diluted EPS with the share options. Okay, so these are the 5 challenges. I have broken them into 5 separate questions. Okay, so let's attack this first one. I believe that once we're done with these questions, you will be feeling really confident and considering EPS an easy topic. Okay, so I'm taking this first question to the Excel sheet. I'm going to continue with the same Excel sheet so that when we upload these questions, these videos on site, we will have this Excel sheet attached to it. Okay, so let's see. So here we go. This is the question. Let's understand the points here. Fine. So you people know the concept of increasing the number of shares in the part of the year where we did not have the right issue. Okay, because you see we have to have the weighted average number of shares evenly throughout the year. Okay, so this was the logic. I will again write the whole concept so that it becomes easy for you. Let's see this question, understand the important details here. What is the basic EPS per share to 1 decimal place for the year ended 31st of December 2027 according to IAS 33? So we are looking at basic EPS. The examiner wants us to calculate the answer in 1 decimal place to 1 decimal place for the year ended 31st of December 2027. So we have this Garfish had profit after tax of 3 million. So there's one thing that I would like to identify here. In case of basic EPS, there will be no change in the earnings. So that is good news. We do not have to do anything to the earnings. Okay. So that is I would call this a good news. So we do not have to worry about the earnings. The earnings will stay the same. Whatever is going to happen, the changes will be related to the number of shares. The number of shares that we call. That is the problem arises when we have to calculate the weighted average number of shares. Okay. So the only thing that we are going to deal with it is going to be the shares. Okay, so these small things make your life easy. That when we are looking at basic EPS, we are not going to change earnings, and we're just going to consider the changes in the denominator, that is the shares. Okay, so let's see. So this thing that they mentioned, the profit after tax is going to be the same, and that is for the year ended 31st of December 2027. On 1st of January, when the year started, we had 2.4 million ordinary shares, and on 1st of April, that is after 3 months, we made a 1-for-2 rights issue. Okay, so we gave one new share for two held, okay, at a price of 1.4, when the market price of Godfish shares was $2. So before the right issue, the price was $2, and the right issue was for 1.4. Okay, so let's write these initial details before we go on. So we have this the number of shares for the first 3 months, that is January, February, and March. Okay, so these number of shares were 2.4 million. So let's write the total value, 2.4 million, and we simply multiply that to 3 by 12. Okay, so this would make your job easy. So this is the first part that we do. Okay, and the number of shares for the later 9 months, that is from this April to December. Okay, so those the number of shares in that period are going to be increased. Like we have this 2.4 million, plus we have the rights issue. So that is going to be for every 2.4 million divided by 2 multiplied by 1. So that is going to be another 1.2 million. So overall, the number of shares for this period would be 3.6 million, and we would do that for 9 by 12. Okay, so this is the easy part. Okay, now we discussed this concept that we have lower number of shares in the first part of the year, that is the 3 months, and in the later part we had the bonus, or rather the right issue. So we need to increase this part as well. Okay, so to increase this one, we need to have the fraction that we need to work out. Okay, so what is that fraction? That fraction needs to be worked out. So you see, we need to increase this part, this portion of the year, the number of the shares in this first 3 months. Okay, how are we going to do that? I hope you understand. You could also recall, like the number of shares in these 9 months have these rights, but in the first 3 months there are no right issues. So we want to have the number of shares evenly throughout the year, because if we do not have that, this is going to have an impact on the calculation of EPS. Okay, the EPS could go up or down without any change in the performance of the company, because you see, we haven't changed the earnings. Okay, whenever there is a change in the performance of the company, the earnings go up or down. The earnings are the same, but the number of shares are changing. So this is going to have an adverse impact on the EPS. So what we are going to do to make the EPS unchanged, we are going to increase the number of shares for this first 3 months. But what should be the treatment? For that, the IAS 33 explains us to calculate this theoretical X right price, and that is calculated as follows. So we have initially we have 2 shares at $2. So because the right issue basis is for every 2 shares, they are going to give us one more. So if we have 2 shares, the total value for this one would be $4, and then we would have one new share, one new right issue, that is going to be at $1.4. So that is going to be, let's take it here, so that we have, okay, and this is going to be 1.4. So now we have in total 5 shares, 3 shares, 2 old shares at once, that is 3 shares, and the value is, so let's these are rounded, so I'm just going to unround them. So that is going to be 5.4. Okay, so the value is 5.4. The value for 2 shares is 4, and the value for this one new right issue is 1.4. This is the way to calculate the theoretical exercise price. So the theoretical exercise price is going to be this dollar 5.4 divided by the number of shares, that is the 3 shares. So we're going to have this value. Let's see, what answer do we get? The answer is 5.4 divided by 3. Oops, I wrote something else here. That is 5.4 dollars divided by 3. So that is going to be, let's again, this is rounded, we unrounded, that is 1.8. So this is the theoretical exercise price. Okay, so this is the price. So we would say the price before the right issue is $2. Price after the right issue, that is the one that we have just calculated, the theoretical exercise price, that is and that is dollar 1.8, and the price for the right issue was that we used here, which was dollar 1.4. Okay, so I have written all the 3 prices. So we are going to use these 2 prices, the price before the right issue and the price after the right issue, okay, for this fraction. So now we are all set. We have to increase the number of shares. So we are going to use these figures in a way. We're going to multiply this to this figure, 2, that is before the right issue, divide by the theoretical exercise price. This is going to give us the value which is higher. Okay, we multiply it to 2 and divide by 1.8. 2 is the price before the rights, and you see, this fraction can be used in any way, depending on the objective. The objective is to increase the number of shares. Okay, so let's see. That is going to be 2.4 million into, first of all, 3 by 12. That is going to give us 600,000. So we're going to take the 600,000 into 2 divided by 1.8. So that is going to give us this number of shares for the first 3 months. Without this fraction, the number of shares were 600,000. But after this one, the number of shares have increased. Okay. However, this later 9 months does not need a lot of calculation. This is just going to be 3.6 million multiplied by 9 divided by 12. So that is, let's calculate the value here. So that is, okay, it's okay, that is 2.7 million. Okay, so overall, the weighted average number of shares are, the weighted average number of shares are going to be this these 2 figures, 667 plus the 2.7 million. So that is going to be the figure. We can just pick these figures here. This is 2.7 plus we can add this one. I've just done the workings for you. So that is the number of shares. Okay, and we also have the earnings. If we just write it here, the earnings, I told you that the earnings are not going to change. That is going to be 3 million. So if we take this 3 million, we divide it by the number of shares. So we will have, we needed to have to 2, or rather 1 decimal place, as the question says. So that is going to be this 0.89. They say, yeah, so that is going to be 0.89. Okay, so that is going to be the EPS. I hope you understand this whole fraction thing. We had to calculate the theoretical exercise price and then use the values. You can have a look at this one and let me know. Yes, people, I hope it makes sense. Yes, what is the question?
I always get confused when calculating the number of shares, right? So it's the first 3 months we multiply by the first 3 months,
Yes,
and then
multiplied by 12.
and then what we get there, the same 2.4, we also add it here again. Please just explain to me only this
Yes,
part where
you see this.
we're allocating the time. That's where I get it confused mostly.
Yes, okay. That is not a problem. That's a small thing. Because you see, for the first 3 months, we only had 2.4 million, but in the later 3 months, we had the later 9 months, we had those number of shares, and we had some new, the right issues, that is 1.2 million. So the existing 2.4 million, we add the new ones, and we get the updated value. But when we multiply it to 9, we get the weighted average. Okay. So these are the existing shares. These were there for the first 3 months, and obviously they are there in the last 9 months as well. The issue is with the right issues. The right issues are the new ones. The right issues were not there in the first 3 months. However, they were there in the later 9 months. Okay.
I hear you. So when we add what was there initially, the first 3 months,
Yes, it was
plus
only
what
the
we have for the 9 months,
yes,
that gives us the value we need as
yes,
the weighted average, right?
exactly.
Oh,
The trick part is only this fraction. That's it. Students
yeah.
usually get confused in this part. Okay.
Okay.
If you're
Yes, sir.
comfortable with this, then you're doing well.
All right. Thank you, sir.
Okay. So let's move on to the next issue, because a similar question was dealt with related to the right issues yesterday. So let's look at the other one, which is related to the second issue. I hope everyone is comfortable with this right issue thing, because now we're going to look at the bonus issue problem. Okay. That's the second issue related to the basic EPS. Let's understand the situation. What is the basic EPS figure for the year ended 31st of December 2024 according to IAS 33 EPS? Here we go. We have this on 1st of January 20x4, that is the start of the year. We had 3 million ordinary shares in issue. And on 1st of June 20x4, that is during the year, we made a bonus issue, made a 143 bonus issue. Okay, this calculation is a bit easier because there is no problem with the theoretical extra price. We can simply make the fraction. Okay, so previously we had 3 shares, but now we have 4 shares, 3 existing shares and 1 new shares. So we need to increase the number of shares for the first 5 months, January to May. Okay, because on 1st of June we are making the bonus issue. And then on 30th of September 2024, Samco issued a further 1 million shares at full market price. Okay. So this situation existed for from June, July, August, and September. They are issuing them on 30th of September. So this situation where we had the bonus issue and the existing shares for 4 months, and then the remaining months, in the remaining months we had the 1 million more shares. So I will just explain the whole thing to you. And the profit attributable, because we need the earnings. Sam had profits attributable to ordinary equity holders of 2 million for the year ended 31st of December 2024. So this is the whole situation. Now let's take this to the Excel sheet, determine for how many months we had how many shares, and let's attack this question. Okay. So just like the previous question, I will write all the details for you so that things become easy. Okay, so we had this situation prevailing for the first 5 months, because in the first 5 months it is the first 5 months. that is January to May, we had 3 million shares. Okay. So when we had those 3 million shares, we would multiply that with 5, divide by 12. Okay. So this is the easy part. We always do that. Then in June, then we had the next 4 months. Okay. Starting from June to September. Okay. We had the bonus issues as well. Okay. So if it is 1 for 3, that would make a total of 4,000 shares. So we would have this 3 million plus this 1 million. Okay. Because I've calculated the 1 million. So that is going to be like, let me just calculate this value for you underneath. I will just write it here working. And this situation is for 4 months. So we multiply to 4 by 12. So that's the thing. So let's just calculate the bonus issues. So we had 3 million shares. And for every 3 shares, we would get 1 bonus share. Okay, so that would give us the value of 1 million. And that would take the total, or that is, we just calculated what is the bonus issues. What are the number of bonus issues? That is 1 million. So that is how I've calculated the 1 million. Okay. So this situation lasted for 4 months, and then we had the last. So clearly, if we had the 5 months and the 4 months, we're only left with the how many months are left? 3 months. Okay. So the last 3 months, that is the October, November, and December. For those last 3 months, we had this 5 million shares, because we had this, let me just do this working here, 4 million plus 1 million new issue. Okay, we had the normal issue. This was not bonus or right. So we had those, and we had that situation for 3 months. Okay, so this is the easy part. So that is easy to understand. I've simply written all the information. What was the time period? How many shares we had? Where is this 1 million coming from? We made a normal issue, like a standard issue, or at the normal price. Okay. Samco issued a further 1 million shares at full market price. Okay. So there is no bonus or right. It is just at a full price. And this happened on 30th of September. So that this situation would be there from the next month, that is October. So that's why I wrote October to December. So I believe this is easy. Let's just quickly calculate the values. Before we do that, let's you see, this is the period in which there is no bonus issue. So now I would say, let's design the bonus fraction. Okay, so we have the shares before bonus were three shares, and the bonus issue was 1 bonus share. And what was the total after bonus? That is just going to help you understand. This is 4 shares. Okay, so before bonus there were 3 shares, and after bonus there were 4 shares. So the fraction is going to be 4 by 3. You see, understanding the logic here, that we want to increase the value of these for the shares in this first 5 months. Okay, so to increase, we have to multiply it to 4 by 3. So I just wrote these values to make you people understand this portion easily. Okay, so I hope this makes sense now. So we take this 3 million, multiply by 5, divide by 12. That gives us 1.25 million. So we take the 1.25 million into 4 divided by 3. So this is the number of shares that would be there for the 5 months. Okay. And now we come to the next 4, that is going to be 4 million, 3 million plus 1 million, that is 4 million, into 4 by 12. This situation lasted for 4 months. So these are the number of shares. And then we had the last 3 months, we had these the initial shares plus the bonus plus the normal shares. So this situation is for 5 million shares. And this situation lasted for 3 months. So this is the number of shares that we get. So if we sum up these figures, we are going to get the weighted average number of shares, and this is 4.25 million. Okay, so let's just so now we have the weighted average number of shares and we have the earnings. So the EPS is going to be the earnings which are given in the question as the earnings are 2 million. So we take this 2 million and we divide this by the weighted average number of shares, which are 4250, which we've just calculated. And we're going to multiply this to 100 because the answer seems like that. So, okay, there's a question. Let me just take it. Exactly. You see, because this is the only period where we do not have the bonus impact. Okay. You see, we are not going to create the impact for the normal, these shares, because these are issued at a normal price. When we issue these shares, we got some money, and that money was actually used in the business to generate profits. Okay. So this normal issue is not going to have any impact because when we made this issue of shares, we raised money because that was made on full market price. So that money can be used in the business. Okay. So no problems with that. But this is the problem because these shares are for free. These 1 million bonus shares. Okay. So I hope you're all set to calculate the value here. This is 2 million divided by 450, and let's see what that value is. We unround that. So that is 471, or we could call it 47.1 cent. Okay, when we multiply to 100. So I hope this is clear. This was the I think this was easy because the fraction was easier to calculate as compared to the right issues. Yes, students, I hope you understand.
Yes, sir.
Okay, excellent. So I hope everyone is with me and comfortable. So this was the second issue we had done with the basic EPS. We dealt with the rights and we did with the bonus. Okay, now we look at the next one, which is the fifth case that I would regard fifth case. I would keep the diluted away, the diluted EPS. First of all, I would like to attack the comparative, like when we have to restate the EPS for the previous period. So this is interesting one. Let's understand the logic behind it. Okay, here we go. What is the restated EPS figure for comparative purposes? We have to have the restated EPS. Why would we restate? Okay, I will explain the logic here. Because we are about to restate what was the EPS that was the previous period. It was calculated in the previous period. What is wrong? Why are we doing so? Okay, this is an important question that should come in your head. So what has happened during this year? Mac made a 143 rights issue at $1.6 when the market value was 2.2. Okay, so here this guy Mac is making a right issue at this price when the normal price was 2.2. Okay, the last year's EPS was 81 cents. Okay, there was no issue of shares during the year. Fine. So what is going to happen in this year? We have made this right issue of shares, so the number of shares is going to increase, and the EPS for the current period is definitely going to be less. It is going to fall. Okay, so you understand that when we make the right issue, the EPS goes down. Okay, let's take this thing to the Excel sheet, and I will write whatever I'm speaking, and that is going to make things easier for you. Here we go. So this is the question. And we see what is the situation, and then we can understand it better. Okay, here we go. In this case, let's only see this question that we're looking at. Okay, we have this, we are making right issue of shares. It will make the number of shares increase. This will reduce the EPS for the current year. Okay, agreed at this point. Yes, students, are you with me? That when we issue new shares at a lower value, obviously the number of shares increase, but we're not able to raise as much money. So there is going to be some dilutive effect. The value is going to go down. So that is going to reduce the EPS. So what is going to be the reaction of the shareholders? Okay, they will be unhappy. Fine. Why? Why would they be unhappy? Should they be unhappy? The answer is no. But the shareholders don't understand. We cannot explain all the shareholders that the company is performing fine. It is just that the number of shares have increased, and due to that, the EPS has gone down. So we cannot do that. But they're going to look at the EPS for the previous period, and they're going to see why the hell EPS has gone down. Okay, and it will be a difficult situation for us. Okay, so what is the solution? The solution is to restate the EPS for the previous year, and so that the shareholders do not get panic attack. Okay, because the shareholders are going to be angry, they're going to panic, they might sell our shares that this company is not good for me. Okay, so so this is this considered window dressing? Window dressing? The answer is no.
No.
Okay, so this makes clear sense. So it is fine to reduce the EPS for the previous period so that the shareholders do not get the panic attack. So now we're going to do that. So what is the situation? The comparative EPS is 81 cents. So we're going to take it down. Okay, how are we going to do that? For that, we need to have the same process of calculating the theoretical XY price. So we need to find the ratio or the fraction to reduce the EPS. Okay, this is what we have to do. We have to find the fraction to reduce the EPS. How are we going to do that? We're going to have the existing how many shares? We have the existing 3 shares at the rate of dollar. The price that is existing is $2.2, and we had one new right issue at the rate dollar 1.6. This is the situation right now. Okay? So we calculate that value 2.2 into 6. That is, let's unround it and get the proper value. Let me just do this unrounding for all this area. So that is 13.2. Okay, the value that we get, and now here we get 1.6. Okay, so the total value, the value for the 3 shares is 13.2, and the value for this 1 share is 1.6. And if we sum up this, we get the value as the value is 14.8. So 14.8 is for 4 shares. Okay, so what is the theoretical XY price? Is going to be this dollar 14.8 divided by 4 shares. So this is going to fetch us the theoretical XY price. So that is going to be 14.8 divided by 4. The answer is 3.7. So the price that is existing. So we had this number of shares and the price before. Okay, we got a feedback. Let me check. 6. Okay. Which 6 number? This 1.6?
I saw you divided 13.2. Under the 13.2, you divided by, there's a number you divided by 6.
Okay, I think this is where I got wrong. I divided it by 6. I divided it with 4.
Yeah.
You
On
see,
the first
we had
line.
these 4 shares. The value for these 3 shares. Okay, that is where I wrong. Yeah, that is the wrong thing. Yes, thanks for identifying. So that would have created problem for us. So yeah, that is only 3 shares. So yeah, that is 8.2 rather. Thanks for highlighting this thing. So that is not 14.8, that is 8.8. We divide 8.8 by 4 and we get a different value. So 8.8 divided by 4, that is going to be 2.2. So that is 2.2 is the value that exists now, and the new value is this. So that is 8.2. Okay, have I got another calculation wrong? No, that's fine. Okay. So now we have 4 shares. The new share, this has to be different value, I guess. Let's see how we have calculated it. Let me just sum this up again. There might be something confusing here. Let me just do the total again. That is 6.6 and that is going to be 8.2. So if we do this 8.2 divided by 4, that is actually 2.1, not really 2.2. The right answer is the theoretical extract price is 2.1. So let's put this here. So what the price after theoretical right price is the after the right issue, and the price before for the right issue is, before the right issue the price was 2.2 and after the right issue the price is 2.1. So the fraction that we're going to use here is going to be multiply this previous EPS. We have to reduce it. How are we going to reduce it? In this case, we're going to multiply to the lower figure and divide by the higher figure. 2.1 divided by 2.2 to get the updated EPS. Okay, so let's calculate this value. You see, in the previous questions, we have been using it the other way around because we had to increase the number of shares. But in this specific case, we discussed that we need to reduce the EPS for the previous period. Okay, so I hope you understand and make the sense of it. So we take this 81 and we multiply this to 2.1 and we divide it by 2.2. So the answer that we get is 77. Okay, let me just see that it is rounded properly. So that is, yeah, so that is 77 cents. So this is the EPS that was calculated previous year as 81. When we adjusted it, it ended up as 77 cents. Okay, so we can just write it here as 77 cents. So this is the restated. So we can say the restated EPS. Okay, why we have done that? So that our shareholders, when they compare this year EPS with the previous year EPS, they do not get anxious and they do not get into this thing that why the EPS has gone down. So since we have reduced the EPS for the previous year, when the EPS for this period is going to come, it is going to be close to this figure. Okay, so they are not going to be troubled, they are not going to be unhappy. So I hope you understand. This was the 5th case, the restatement. Again, you need to understand the objective. The objective was to reduce the EPS. So to reduce it, we multiply it to a lower value as compared to the higher value. The lower value is the price after the right issue, and the price before the right issue was a higher figure. So since we wanted to have the low value, we multiply it to 2.1. Okay. In the previous questions, we have been multiplying it to the higher value. If you remember this question, we wanted to increase the number of shares in the first 3 months. So the theoretical ex-right price was 1.8 that we calculated here. So we multiplied it to 2 because the objective was to get to a higher value. Okay. So this is the important point that you need to keep in mind. When to use which fraction, you need to know what you want to achieve. Here we wanted to achieve the increase in number of shares, and here in this case we wanted to reduce the EPS for the previous period. Okay, and I wrote the whole thing for you so that you understand the rationale behind it. Okay, we could just write it here.
Yes, sir.
Okay, so now we are moving towards the last two issues. As I told you that we are looking at 5 issues related to EPS. So we are done with the basic EPS and we are now looking at the diluted. Okay. So when it comes to the diluted EPS, we will always have the convertibles and the share options. So let's see. In this case, we have the convertibles. Let's look at this thing. What is the diluted EPS? Okay, so whenever you see a question, you should be keeping in your mind it is going to be convertibles or share options. So let's see what is the issue here. Coral Co has net profit for the year ended 30th of September 2025 of 10,500, or 10.5 million. Here, when it comes, this is the only case of EPS where earnings are going to change. Okay, here the earnings are not going to be the same. The earnings are 10.5 million. Why am I saying the earnings are going to increase? Because you see the convertible loan note, the convertible debt is going to be converted. So when it is converted, we will have to pay less interest, or we will not have to pay any interest. So that is going to increase the earnings part. Okay, you understand the logic that in this case, we had this obligation, and this obligation is going to be cancelled because we are going to assume that the convertibles are actually converted to shares. So when they are converted, we will not have to pay any interest. When there is no interest, then there is going to be an increase in the net profit. Okay, so we will calculate how much of the interest we have saved. So in this specific case, the earnings are going to go up. So this earnings is not going to stay the same. We're going to work it out. Coral has had 6 million shares. So this was the number of shares before the conversion in issue for many years. On 1st of October 2024, Coral issued a convertible bond. So now the convertible bond is coming. It had an initial value of 2.5 million, and the market interest rate for the non-convertible instrument is 8%. And the bond is convertible in 5 years. This is the important thing. With 50 shares issued for every $100 nominal of convertible bond held. So overall value of the convertible is 2.5 million. So we divide the 2.5 million with $100 and we multiply it to the number of shares. So we will get to know how many new shares will be issued. Okay, and there is some element of tax which I'm going to discuss in a short while. Okay, so first of all, let's get done with the increase in number of shares, and then we can. But that is easy. Okay, that is not challenging part. That is easy. What I think is going to create a bit of a problem is the calculation of the increase in earnings. Okay, let's see how you people see it. So we have discussed all the aspects, and now we have the existing shares are 6 million, and the new shares after conversion. So we have to calculate their value. So the value of the convertible is 2.5 million, and for every $100 we get 50 new shares. So this is going to help us calculate the new shares. So that is going to be 2.5 million divided by 100. That is going to be 25,000. So 25,000 into 50. So the new number of shares are 1.25 million. So the total is the total number of, or the total shares after conversion. So you see, this is easy. This is not a problem. So that is 7250,000. That is easy part. I would say you think the same. There was no technicality here. We could easily calculate the number of shares. Now comes the earnings part. So the earnings, they have given us the earnings as 10.5 million. And now we have a saved interest. We have some interest saved. So how much is the interest? The interest is, we could say 2.5 million multiplied by 8%. So how much is that? 8%. We're going to calculate this value. So I'm going to write it here because that is not the final figure. So 2.5 million into 8%, okay? We haven't really saved all the interest, okay? Less the tax effect. Why am I deducting the tax effect? The reason is this is important, and I will write some notes here so that it becomes easy. Okay. When interest is paid, this is not technical, but if you follow it, it is going to be very easy to understand. When interest is paid, the profit before tax reduces, and this results in less tax. Okay, agreed. This is simple, because whenever we pay interest, the profit before tax is a reduced figure because the interest is deducted, and this results in less tax. Okay. However, we're going to continue with this. However, so we could write here one more thing. This means that there is interest save. There is tax saving by paying interest. Okay, so this is an important thing, that whenever we pay interest, we save tax. Okay, so if no interest is paid, the profit before tax increases, and the tax saving is gone. Okay, so this is easy to understand because we are not paying any interest. We are saving this interest, but there was some tax saving. That tax saving is not going to be there. So the tax save, which was before, but it is not available anymore, it is going to be this 200,000. 200,000 multiplied by the figure 28%. So this tax that was saved is not going to be there anymore. So we're going to take this 200,000 and we're going to take 28%. So we're going to deduct this figure because there is no tax effect. So what is the figure afterwards? The afterward is going to be the real saving in interest. Okay, so let's sum these figures up to understand the value. So that is 144. Okay, so this is the actual interest saved. We saved the interest of 200,000, but the thing is, there was less tax saving. Okay, so the earnings, the restated earnings figure, so we say the updated earnings figure is the sum of these two, which is going to be this plus this. So that is the earnings figure that we're going to take. So now we have got the updated earnings, and we have the updated number of shares, and we will have the EPS. Okay, we can say the diluted. The diluted EPS is going to be the earnings, which is going to be 644,000 divide by the number of shares are 7,250,000. Okay, and that would be multiplied by 100, considering the answer that is in cents. So let's see. Let's calculate the value here. This is 1064 divided by the number of shares multiplied by 100. The answer is 147. So let's this should be 147.6. Let me just unround it. or it is 146.8 rather, if we unround it. So here we go. Yeah, the answer is 146.8. That is the correct answer. Okay. So you see, in this part, the trick was in the interest saving. Okay. And I told you when we save the interest, it is not the whole interest saved, because the tax effect will reduce the interest saving. And I wrote the whole logic behind it. I explained when the interest is paid, the tax reduces, and obviously when the interest is not paid, there is no tax saved. So we have to accommodate that as well. So the real saving is only 144,000. So the earnings is this figure. Okay. So I hope you understand. This is the first case of the diluted EPS. We are only left with one case, and which is easier one. Yes, people, I hope this makes sense.
It does make sense. I think I was confused, but now I really understand it. Like we first of all have we we have convertibles, right? And
Yes,
then we try to see like if we convert everything, how much EPS are we going to have, like a new one, because it's going to dilute what we currently have. So we start
exactly.
off like having what we have at the moment, and then the new shares we're going to have, then we have the new figure for the shares, and then we also adjust the earnings
Yes,
because when we're not converting, we're not going to pay interest, and that is an interest of there's a saving of interest and tax. So that's like we add it to our earnings and then we calculate the EPS.
exactly. This is the only case where we
Yeah,
adjust earnings. Otherwise, in none of the EPS
yeah.
questions, we will be adjusting earnings. Okay. So it's very
Okay.
good that you have understand it. I hope all of you are still with me and understanding and making good sense of it. That's good. So fine, if there is any issue, you can always stop me and ask questions. So we are about to attack the last case, and then we will be done with EPS. Okay, this is the last case, that is the diluted EPS, the second case for diluted EPS. Let's understand this one. Here we go. This what is ISCO's diluted EPS or diluted earning per share for the year ended 31st of December 2025. So we're looking at the diluted EPS. Uh, this is ISCO's financial statements show a profit for the year to 31st of December 2025 of 2 million. So in this case, we're not going to change it. Whenever there are share options, there is no change in the earnings. So that is good news. No real workings here. Okay. However, on 1st of January 2025, ISCO had 4 million shares in issue. This is fine. These are the existing shares. However, and made no further issue of shares during the year. But at 1st of December 2025, there were 1 million outstanding options. These haven't been exercised, but they are there. They can be exercised at any time. So if you want to calculate the diluted EPS, we are going to assume that they are. If what will happen to the EPS if they were exercised? So 1 million outstanding options to buy shares at $3 each, and for the year to 31st of December 2025, the average market price of ISCO shares was $5. So the option for these outstanding options was the price was $3. However, the normal price was $5. So there is some bonus element. Some of the element of these shares is for free. How much is that? That is clearly $2, because the normal price is $5 and we only have to pay 3. So $2 is the bonus element. So we have to calculate the new shares according to this bonus element. Okay. So we will take this to the Excel sheet and understand how we can use this the bonus element thing here. Okay. Let's see. So this is the easiest of the case, I believe. Nothing much to it. It's a very simple method that we're going to use, and we're almost done with the EPS. Okay. However, these are the questions. These are the typical questions. But I would recommend you people to go for the questions on ACCA Hub, because ACCA have made slightly different questions which challenge your understanding. But what is the difficult part is this. Those questions you will find it easy. I have got those questions uploaded in the list of live sessions. Okay, so let's see. We have this let's just show you this part of the question. Okay, so we have the earnings. We agreed EPS is equal to this earnings of 2 million. I'm just going to write it here, and we divide by the number of shares. So this is what we're going to find out. So the existing number of shares are 4 million. And the free shares. Okay, why I would call free shares, because the share options are 1 million, and the bonus portion is $2 as compared to the normal price of $5. Okay, so this is going to help us find the free portion. Okay, so that's going to be this 1 million into 2 divided by 5. So these are the number of shares which are considered free. Okay, like for them we're not paying anything. What we are paying is only $3 at a situation, at a date, or at a point when the normal price is 5. Okay, so that is going to help us reach at the value which is 4.4 million. So that is the number of shares now. Okay, so if we just calculate this value, and now we could just use this value here, and we multiply that to, so that is 4.4 million multiply by 100. So that is going to get us the answer. So let's see. We have this the earnings, which are 2 million, divide by 4,400 multiply by 100. That's going to be 45, or if we just unround it, we will get the exact answer. So they've got it to 1 decimal place. So that is really 45.5 cent. Okay, that is 45.5 cent. This is the final answer. So I believe this was the easiest of the cases that we dealt with. We dealt with some really weird scenarios for the basic EPS, the right issues, the bonus issues, the adjustment of the comparative EPS, the EPS for the previous period. Then we looked at the diluted. In the diluted, we had the convertibles, and then we had the this diluted in respect of the share options. So students, I hope you have benefited, and EPS does not seem to be a monster, because honestly, when I was the student, I felt that honestly, I never understood EPS. I never understood it. So when I had to teach EPS for the first time, I had to understand it. Okay, and when I understood it, I thought that how easy was it. Okay, you see, there is just this little thing, when to use that fraction, how to design that fraction, and when you know that, then everything is easy. Again, you see here, there is a fraction, 2 by 5. We have to pay 3. So what is the bonus element? It is $2 by 5. So we had the fraction for the theoretical extra price for the right issues. We had the fraction for the bonus issue. So it is all the game of this fraction. If you understand that, then things will be easy. Yes, what is the question?
Yeah, I'm trying to understand the fraction for this last question, because I'm seeing that at 31st December, there were 1 million outstanding options to buy shares at $3 each for the year ended 31st December. The average
And when the
market
price is 5.
So I'm wondering where the 3 came from. I'm just trying
You see,
to.
yeah. When you want to have those shares, the company is offering the shares at $3. If you want to exercise, if you want to buy those 1 million shares through that option, you only have to pay $3. When the real price, the market price, is 5. So what is the free element? It is $2 per share. you are paying only $3, but anyone who does not have the share options will have to pay $5. So clearly you are at a, in the advantage situation. By how much? By $2. And we multiply this $2 divide by the normal price $5, and we consider that the dilution element, the free element of the shares. Okay.
Okay, it's okay. Thank you.
You're welcome. So students, I hope we are comfortable, and I expect you people to be confident now dealing with the EPS, but I must say that this will require some practice. I recommend you, I have already shared this document with you in the group. I expect you people to practice these questions. We will be uploading these videos shortly, so you can go through them and you can develop a better understanding. Okay. So if you have any questions, you can ask me. Otherwise, we can conclude the session here. In the meantime, in the remaining time, you should be looking at the questions, the important areas. And if you find any problem, you can always approach me and I will explain those issues. Okay. So students, I believe this is all. And we have concluded the revision series, and I hope it was useful. We attacked number of different challenges posed by the examiner, and I feel that we find ourselves in a more stronger, confident situation. Okay, so that is all for the day. Take good care, everyone.